Welcome to Passive Cash Flow, a channel dedicated to guiding you towards financial independence through sustainable passive income streams. This video is about investing mistakes to avoid in the stock market if you are a beginner or you are new to stocks. This is a good beginner-level video and intermediate-level video for investors in the stock market. When a company publicly declares bankruptcy, it's a glaring red flag that you should not ignore. Investing in a company at this stage is like walking into a financial minefield. The fact that a company openly admits to its financial downfall is a clear signal to stay away. Despite the announcement of bankruptcy, the stock will still be traded, with no obligation for immediate delisting. Here's the stark reality. If you choose to invest in a company facing bankruptcy, hoping for a miraculous recovery, you're treading on dangerous ground. In most cases, such stocks face complete obliteration, leaving shareholders with nothing as the stock value plummets to zero. Attempting to turn a quick profit by buying at a low point and selling slightly higher becomes nothing short of a gamble. In essence, if a company announces its descent into bankruptcy, the wise move is to avoid it altogether. Engaging in such an investment would be considered imprudent or, in simpler terms, akin to gambling. Spare yourself from this detrimental mistake and opt for a more strategic and informed approach to investing. The second mistake when investing is to avoid buying penny stocks from the over-the-counter market. Instead, focus on your stocks on reputable exchanges such as the New York Stock Exchange or NASDAQ. Do not buy pink sheet stocks, as these companies usually fail to meet the requirements to be listed on reputable exchanges or have been delisted. This indicates that these companies are not reliable. Therefore, avoid the OTC market as it is very dangerous. If you are a beginner, focus on reputable exchanges and stocks on those exchanges. The third mistake is to avoid participating in online forums. You don't want to open that Pandora's box. You'll just be talking to weirdos on the internet. They won't add value to you, and you won't have productive conversations. You won't be able to exercise the necessary caution when talking to these weirdos. Avoid those online forums. Mistake number 4. When investing is attempting to be a day trader if you're a beginner. If you're new to the stock market and you try to buy and sell intraday, you'll most likely end up losing money. Although you might have a good day or two, it's mostly just luck. You can find out the hard way if you want, but I wouldn't recommend it. Instead, I suggest buying and holding for the long run. This will probably be the best strategy until you've gained some experience and understand how stocks work and how the market moves. If you want to do buying and selling, then swing trading is a better option. This involves holding for a few days, weeks, or months, which is a longer hold period. If you try to buy and sell intraday in the same day, you'll be competing against professionals who use much more sophisticated software and teams. You're picking a losing battle. These are my investing tips. Mistake number 5 when investing is trying to time the markets. We don't have crystal balls, and even the best stock pickers don't have crystal balls. This means that we don't know the future. The stock can go up, down, or sideways, and who knows. The best approach, especially if you're a beginner, is to get into the market with a staggered approach. You can set some money aside each month to deploy into the stock market, like a systematic approach. For example, every month, you can put in X amount of dollars. This way, you're averaging in, and at least you won't be buying at the very top. Unfortunately, you won't be buying at the very bottom either. It's going to be a mixed approach, so that's going to give you an average that will ensure that you're not overpaying. You won't be getting the best deal because you need to time it perfectly, but you won't be overpaying. Just get in with a staggered approach. Avoid trying to time the market because if you do, you would have missed out on all the gains for the past 10 years. If you were on the sidelines just saying, I think the market's going to fall, I'm going to wait for a huge dip, I'm going to wait for the next recession, you would have lost out. So, it's better to get in little by little each month or each few months. Investing mistake number 6 is to pay attention to the general markets. During good times, it is important to pay attention to the general market, the overall macro environment. If the stock market is going up, everybody is going to look like a stock market whiz. Everybody is going to look like a stock market guru, like they're going to look like a genius. So if you are up 20% with your stock picks, but the general market is up 30%, then you're actually not that great of a stock picker because the overall market is performing better than you are. During bad times, don't kick yourself and don't get upset with yourself if your stocks are going down. You need to compare how much your stocks, your portfolio, or your picks go down in comparison to the general markets. If your stock picks or your portfolio is down 5% but the overall market is down 20%, then you did great. You lost 5% when the overall market lost 20%. You outperformed the market, so you need to take into consideration the overall market, the general markets. Investing mistake number 7 is to be cautious of stocks that are paying too good to be true dividends. If a stock is paying a dividend yield of about 20% or 25%, that should be a red flag. You should do extra analysis before investing in such a stock. Although it may seem awesome to earn 20% in dividends, usually in that situation, it's too good to be true. Investing mistake number 8 is putting all your eggs in one basket. This is investing 101. You need to make sure you diversify. Don't fall in love with the stock no matter how good or solid you think that stock or that company is. You need to diversify. Don't go all in on one stock. Here's an example. Enron was once a very reputable company until it was found out to be a fraud and went to zero. Many employees of Enron had stock options and all their savings in Enron stock. With their investments outside of their stock options, they even bought more Enron stock. They were 100% all in on Enron, which was once thought to be such a reputable name brand company. One day, it was found out to be a fraud and went to zero. Shareholders and people's retirements, their savings were wiped out because they didn't diversify. You need to diversify because even if you think that stock is untouchable, it's possible for it to go down to zero. Anything's possible. You're reducing risk by diversifying and spreading your investment across multiple companies, because the chances of one stock going to zero is much greater than 100 stocks going to zero. So don't make that mistake. Mistake number 9 in investing involves underestimating the significance of trading volume. This error holds immense importance, as it can lead to being ensnared in a particular stock. Even if you invest in a stock that experiences a rapid surge in value, without sufficient trading volume, you could find yourself trapped, unable to exit the position and capitalize on any potential gains. This illiquidity arises from the absence of trading activity. In simpler terms, trading volume refers to the total number of shares of a stock being traded on any given day. Therefore, it's essential to closely monitor both the daily volume and the stock's average volume. If the average volume is notably low, caution is warranted. Purchasing a stock with insufficient liquidity may result in a situation where you are unable to sell your position. The decision ultimately rests with you. If you come across a company or stock with an average volume less than $10 million, exercise extreme caution. In stark contrast, many companies listed on major exchanges like the NYSE or NASDAQ boast volumes in the hundreds of millions or even billions. But I mean, if you are looking at a stock that has volume and dollar values in the tens of thousands or hundreds of thousands, that is a red flag because, again, it might be a trap. Because you will literally be trapped in that stock and you could not get rid of it even if you wanted to. Investing mistake number 10 underscores the critical importance of having an emergency fund. It's not just a mistake, it's a potential problem waiting to unfold. Imagine the scenario where you find yourself in the midst of an emergency without a financial safety net. What options do you have? The likely recourse would be to liquidate your stocks to sell off your investments. Consequently, if you lack an emergency fund, you might find yourself compelled to sell your stocks at an unfavorable time, especially if you need immediate funds. Consider this. The market takes a sharp downturn, and your initial strategy was to wait it out for a few weeks, months, or the long run, expecting a recovery and potential profitability. Yet, if you're in a tight spot, urgently requiring funds, and without an emergency fund, you're left with little choice. You end up selling your stocks precisely when their value is at a low point, and your anticipated outcomes don't align with reality due to the urgency for immediate funds. This narrative is a familiar tale, a recurring theme in financial experiences. Therefore, if you find yourself without an emergency fund, it is advisable to prioritize building one before venturing into the stock market. This is more than a suggestion. It's a proactive measure to safeguard your financial well-being. I trust you found these insights into investing mistakes enjoyable and educational. My hope is that you can integrate these lessons to enhance your skills as an investor, especially if you're relatively new to the stock market. Should you decide to embark on your stock market journey, explore our comprehensive video series offering valuable guidance and tips for newcomers. Additionally, if you choose to start investing, consider using our affiliate link below, which comes with the added benefit of receiving free stocks to jumpstart your investment journey. Thank you for your time, and I encourage you to subscribe for more valuable content. Take care.